All right. Well, good morning, everyone. Thank you for taking some time as we provide the conclusion of a year's work looking into the adult family home liability insurance market. I'm David Ford. I serve as the Senior Policy Advisor for Property and Casualty, and I've been asked to represent Commissioner Kuderer today. We want to thank all of you that has participated in the interviews, often multiple interviews over the past year. Those were very helpful to gain context on the situation, helped us understand the Washington market and the critical services that our adult family home operators provide, and the diligent regulatory environment provided by our Department of Social and Health Services. I saw that there might be a name change and a reorganization, but I want to recognize specifically the staff in the formerly named Aging and Long-Term Support Administration, who are assisting our state to meet the needs to honor the rights, the health, and the safety of vulnerable adults living in these communities. Additionally, we want to thank the insurance companies that participated in the OIC's data request. In speaking with many of them, they care deeply about the Washington adult family home insurance market and want to continue providing coverage in our state. Their support of this working group and the responsiveness to our inquiries and requests were an important factor to the findings you're going to hear about today. So for today, we're going to discuss the current draft report. The final report must be transmitted to the legislature by the end of this month. As I introduce Rebecca Freitag, I also want to express how grateful the OIC is that Davies Actuarial Audit and Consulting took on the challenge, really, to look into the adult family home liability insurance market. Along with Rebecca, her team of Rosemary Wickham, Jeff Dozier, and Stuart Leslie from Davis Malm, and the many others in the staff that worked on the project, they were truly incredible to work with. This group has decades of experience looking into these types of insurance markets across the country. We were very fortunate to have them involved. So with that, I want to hand it over to Rebecca to walk through some of the findings, and then we can open it up for discussion. Rebecca.
Thank you so much, David. And I'll just say on behalf of Davies and Davis Mom, how wonderful it is always to work with the OIC. And I hope everybody on this call knows how much the members of the OIC are trying to work on behalf of all of the stakeholders and trying to find really creative and amazing solutions for the insureds and to continue to ensure a viable and a thriving insurance market. And not always easy to balance those considerations, and the OIC is really dedicated to that challenge. So thank you so much, David. It's always a pleasure to work with you. Okay, so I also would like to thank everybody who's on this call. We've talked with some of you, like David said, sometimes multiple times. My feeling about these presentations is that there's usually there's going to be at least one person on the call who knows one slide better than I do, because you're the expert on that slide, except maybe for the actuarial portion, maybe. But otherwise, we have relied so much on our research and also our discussions with the working group members for so much of this. So my goal really is to try to tie, everybody in the phone call has kind of disparate pieces of expertise. Part of our goal was to try to tie it all together and come up with something that might work for everybody. Okay, the people, David already said it, but Rosemary Wickham and I, Rebecca Freitag, work for Davies Actuarial Audit and Consulting. We do a lot of work on market studies, and I lead the regulatory practice. And then Stuart Leslie will also be presenting today. He's an attorney with Davis Mom. He does quite a bit of insurance regulatory consulting. He works on a lot of market studies with an eye towards legal and compliance issues and solutions. Works on examinations and receiverships. I've worked with Stu for 16 years. Sometimes I'm working for Stu, sometimes Stu's helping me, and we're so grateful for his help. Okay, we have a lot to get through. I hope we get through most of it. We'll definitely get to the end, even if we have to skip some. This is the presentation structure. We'll talk about the purpose and approach of our study, some background on adult family homes, things we learned from researching other states, type of facilities that might be similar to adult family homes, the liability insurance environment for Washington adult family homes, our data call and actuarial analysis, suggested policy options, and then questions and discussion. And just to reiterate, well, the purpose and approach of the study was, I'll read the bullets, but the ultimate, our report talks about, affordability and availability of liability insurance for Washington adult family homes. And that was really the focus of the study. So it says here, the legislature in its 2024 supplemental operating budget directed the Washington Office of the Insurance Commissioner to convene a work group to review the availability and a cost of liability insurance for Washington adult family homes, identify any obstacles to obtaining that insurance, think about the financial risks if people don't have that access to coverage, and make policy recommendations and submit a report. If anybody's not on mute, could I just ask everybody to mute? Anybody might not be on mute by accident. So we, Davies, were engaged by the insurance commissioner to conduct this study. And our approach included research on Washington adult family homes, regulatory, legislative, and insurance and administrative background. A lot of you helped us out with that, in addition to other research. Interviews and surveys with market participants, like we just said, including, of course, DSHS and adult family home members and adult family home council and insurance company representatives and brokers. Review of, like we said, other states, types of facilities that are similar, and of course our data call and actuarial analysis and working through policy options. Okay, so this is the part of the story where I think many of you know know a lot about this. This is, we just get some background to orient everybody. And in the interest of time, I'll probably go through these slides somewhat quickly. So as you all know, our CW the revised Code of Washington, I think it is, right? 70.128 talks about adult family homes. They need to promote the health, welfare, and safety of residents. That DSHS, in its role as the licensor and administrator of the adult family home system, should aggressively promote protections for the vulnerable populations it serves. And it defines adult family homes as residential homes in which one or more resident caregivers provide room, board, and services to between 1 to 8 adults not related by blood or marriage to the caregiver. And we're going to touch on this later. I think everybody on this call knows this, but it's really important to note that, of course, adult family homes in Washington serve a very diverse population. So the majority of the residents are elderly, but it can also serve people with developmental disabilities. It can serve people with mental health challenges, behavioral things that they're working on. So it serves a very diverse community. The big bold item in terms of this report is that WAC 38876 requires that adult family homes maintain commercial general liability insurance and professional liability insurance as a condition for licensure. So just if anybody on the phone isn't so familiar with those two types of insurance, general liability insurance means if somebody slips and falls, let's say a visitor comes to my house and they fall or they slip or something else happens to them and they make a claim against me, that would be covered against general liability insurance. Professional liability insurance covers errors or omissions conducted by professionals in the course of their work. So that would be if a resident or an estate of a resident claimed that an adult family home, there was some error or omission in their services and that resulted in a negative outcome. According to the WAC, the required minimum liability limits are $500,000 per occurrence, $1 million annual aggregate. So if there's a claim made about one occurrence, that most the insurance company will pay under that policy is $500,000. Or if there's a number of claims, the most the insurance policy will pay in a year is $1 million. That's the minimum limits. Liability insurance, in addition to being required as a requirement of licensure, it's really important because it helps out two entities. It provides security for the payment of damages to an injured party. So if somebody is injured, it makes sure that there's a vehicle to pay them for what they've suffered, what has happened to them. And then it also provides financial protections to the adult family homeowner. In the case that a claim is made against them, they have financial protection, and also the insurance company will defend that claim. So they'll pay for the litigation costs up to the certain limit. A little bit more about background. This was some very good slides provided by DSHS, Department of Social Health Services. As David said, it was the Aging and Long-Term Care Services Administration, right? They provided some great slides in the first working group, which were really helpful. As I said before, there's all kinds of people who are in adult family homes, mostly elderly, but then really diverse population, and special training is required for special needs like dementia, developmental disabilities, mental illness, and traumatic brain injury. Sorry, I have a little elf in my house who just turned off the light. He likes to save electricity. Okay, so one of the slides that was provided, it's not an adult. It's a child who's home. Anyway, one of the slides that was provided by DSHS in the first work group presentation is so interesting. It's such a good background for adult family homes. This slide talks about the acuity, the client acuity in adult family homes. Different entities have different measures of acuity, but acuity is essentially a measure of how acute the patient's or the resident's needs are. You can see on this graph, the dark blue at the top, group 1, is extremely limited activities of daily living. That's what ADLs are, often immobile. And then it goes down to the green, group 5, moderately limited activities of daily living. So on the left side of the slide, you'll see the adult family home client acuity as provided by DSHS. And you can see that groups 1 and 2, which are the groups that require the most care, they form more than 50% of the population of adult family homes. In contrast, if you look at the top right, assisted living client acuity, those two groups are only about 14%. So we can see here that adult family homes are not just a kind of a residential version of an assisted living facility. They're actually providing, for the most part, they're providing a much deeper level of care than an assisted living facility. And then this is just another slide. It just shows kind of the trend of the projection for how many beds will be needed in adult family homes. The orange is the beds that were already needed, and then the blue is the projected beds. You can see that we really need our adult family homes to be functioning well. DSHS is projecting quite a few residents to be serviced by adult family homes. Almost done with this little part, this introduction background part. So adult family homes, somebody needs to pay for the resident to have that bed. Obviously, the operator needs to receive income in order to be able to maintain the adult family home. So there's different ways they could receive income. There are a percentage of individuals, residents in the adult family homes who are private pay. They have their own resources accumulated over the years to pay for that, great opportunity to live in a residential setting as they age and can no longer be independent. But the majority of the residents are not private pay. Certainly more than 50% and perhaps as much as 80% of the residents, their fees are paid at least in part by Medicaid. It's a little bit hard to get a correct metric because it's the number of residents divided by the number of licensed beds. The adult family home is licensed to have a certain number of beds, 6 or 8 or whatever, and it's not divided by occupied beds. So that's why it's at least 53, 54%, but it's probably much more than that. Okay, and since such a big population is much of their cost is paid for by Medicaid, it's important to understand how is that payment work. And basically, according to the contracts between the adult family home and DSHS, there is a daily bed rate that is paid per resident that's Medicaid eligible. And the daily bed rate is determined by negotiation between the Adult Family Home Council and DSHS. And the daily bed rate depends on some kind of baseline operational expenses plus the care expenses based on the comprehensive assessment reporting evaluation, the care assessment that's done upon admission and then annually for the resident. So that daily bed rate that's paid is only paid for the residents actually occupying a bed at that time for that day, and it's based on their acuity, as we talked about before, their level of care that they need. So all of this together means that adult family homes, as DSHS emphasized in that first working group meeting, and certainly has been emphasized by many parties, adult family homes are really an essential part of the care system in Washington State. They are more economical certainly than a nursing home or a psychiatric hospital. For instance, the rates for the average rate for an average daily bed rate for an adult family home resident is about half the rate of what would be paid to a nursing home, and less than a quarter of a rate of what would be paid for a psychiatric hospital. So it's definitely a good, solid venue for the increasingly aging population. When we talk about the average daily bed rate, I just want to emphasize that's the average rate. Residents with more needs may have a higher bed rate than the average, right? And then also DSHS may provide other funding for other contractors depending on the resident's needs. But all in all, the adult family homes really provide a lot of value to all the parties involved. And then one last little bit before I pass the baton over to Stu. We were really lucky and fortunate to work with members of the Adult Family Home Council and to talk with them about what their members are experiencing. We, as Stu will discuss, or he may or may not discuss depending on how much time I give him, and we found a California study from 2018 about adult residential facilities and their financial needs and whether their financial needs were being met and allowing them to maintain viability. And that study included several sample budgets with itemized income and expenses. And we really were curious, there was this kind of a real desire to understand, if the insurance currently is affordable for our adult family homes, and to really understand that we wanted to get a better picture of what's the total picture of anonymized of the income statement for adult family homes. What piece of the pie is insurance really taking? It didn't turn out to be possible to get that information, but AFHC did issue a survey to its members to try to get more information about insurance and affordability and availability in recent years. We had 41 respondents to the survey, which was a small percentage, but was still very valuable to read their responses. And so we just wanted to share some of the comments with everybody. One key takeaway, which I bolded because I think everybody agrees on it, is that adult family home owners are operating on a very limited budget. So I think, as we'll see later, some of the pressures from insurance, sometimes they're for certain adult family homes, there really are significant insurance standalone pressures. But I think that in general, the adult family homes are operating on a very, very tight budget. So that's something we considered when we were looking at the insurance costs. Talked about how many many of them had residents eligible for Medicaid. Interestingly, 26 out of the 41 respondents talked about the diversity of the residents they had. And so, just as one example, one respondent said they accepted residents with HIV, dementia, developmental disabilities, mental health issues, and behavioral issues. Another one said they provide medically complex private duty nursing care for the highest acuity residents. Those are things we're going to have to think about as we think about the insurance cost for some of these facilities. Some adult family homes were paying premiums of less than $4,000 annually, but still expressed concern that those premiums were too high and crowding out other operational costs. And some said they had to make some painful decisions about which residents to admit because they knew it would impact their insurance premiums. So that's a very quick background on some of the things we learned. I'll leave it to Stu to talk about what we found in some other states.
So the charge was to try to understand affordability and availability of liability insurance for adult family homes. That is a subject which there may be experience in other jurisdictions. These are not unique entities. Washington is one of the leaders in establishing and operating adult family home, these home-like residential facilities. But understanding if this is a typical experience in other states or how other states' markets or regulatory structures were operating could help provide some context for analysis of the overall health of this market and options that Washington might want to consider that have been road tested by others. So what we did, and I think, thank you, Rebecca, we started with looking to see what other literature was available. We found very useful studies conducted by the Federal Department of Health and Human Services, primarily focused on assisted living facilities, but also including a brief survey of what they refer to as adult foster homes, but different terminology used in different jurisdictions. That gave a sense of where other jurisdictions that have tried to grow this type of facility. And the AARP also put together a study several years ago about what their members might want to consider as far as alternative facilities and recommending this kind of adult family home setup. So we used those kind of national studies, which weren't insurance specific, but spoke to the overall regulatory structure. And we selected 6 states that we viewed as potentially analogous or having large similar operations: California, Florida, Hawaii, Idaho, Oregon, and Texas. We tried to get geographical match and similar type facilities. So no states seem to have exactly identical. It's not like there's a model law out there. And many states use the same terms to refer to very different things. I'm in Boston. An adult family home in Boston is a situation where you actually have a caregiver move into your home, which is sort of the opposite of what Washington does. So trying to keep track of the different structures and understand who is similar to Washington and how they may be different in ways that could help understand the dynamics here. The first state we looked at, California. As Rebecca mentioned, there was a very interesting study in California several years ago with adult residential care facilities, which is, you'll see at the bottom of the slide there. California has a range of facilities offering sort of different segments of the population that might be served by a Washington AFH. In general, the California DSS licenses facilities that provide residential care, non-medical, so generally lower levels of care to elderly, children, adults with mental, physical, developmental disabilities, mental illness, and they have specific homes for folks suffering from terminal illnesses and HIV/AIDS. So California within those groups has specialty licenses that are based in large part on acuity. and they kind of grade levels 1 through 4. So the license you get in California is going to be narrower than in Washington. So the subset of the population that'll be living in any particular home is more homogeneous. In California, the most closely analogous kind of entity is a residential care facility for the elderly. In California, they mandate liability insurance with limits of 1 million to 3 million, so higher than the WAC limit mandated in Washington, and in the aggregate higher than the Washington contract limits, which is an issue we'll discuss in a moment. So California, narrower licenses and a similar approach to what we can kind of broadly think of as financial responsibility. So in Washington, the risks that you might get from liability in the home, liability from the provider are addressed through insurance. In California, they're addressed through insurance as well, with slightly higher limits. Florida, a state obviously with a large elderly population, also has a range of facilities that offer care to folks who might all fall within the AFH bucket in Washington. You'll see there are 3 types that we thought were the most analogous to Washington. The group homes, those are generally lower levels of acuity, and they range in size to smaller than a Washington AFH, to substantially larger with 15 residents. But those are family environment type homes, so common living area, common eating area, and the like. Adult family care homes are similar to Washington. They, in fact, probably the most similar of the various entities. In Florida, they are generally limited to serving individuals with lower acuity. So once a resident is bedridden in Florida, they need to move to a facility that provides a higher level of care. And assisted care communities are, again, home-like, but they provide more intensive care, consistent with what some of the higher-end care facilities in Washington offer. In both cases, Florida does not have an insurance mandate. So those entities are going to be operating with, in many cases, just homeowners insurance. The next state we looked at was Hawaii, which has a well-developed system of kind of alternative care facilities. The closest match to a Washington adult family home are what are called ARCHs, adult residential care homes. There are 2 kind of broad licensed entities. Type 1 are just smaller, 5 residents versus 8 in Washington. And they can only have moderate ADL assistance. So those group 1 and group 2 type acuities that would be served the majority in Washington, those are not in, those type of residents would not be in a type 1 or type 2 ARCH. Instead, Hawaii has what are called expanded ARCHs, which it's a specific license for facilities with those higher levels of care required. Hawaii had about 2,700 beds as of the last study that they had available. They require liability insurance for their ARCH facilities. We were not able to identify what the limits were from the statutes, the regs, or publicly available contracts. But it appears to be a situation similar to Washington. And then there are specialized homes for individuals with developmental disabilities, and then those community care foster homes listed there are for folks with fairly intensive requirements, almost consistent with a skilled nursing facility, but providing care in a home-like setting. Idaho, the next state we looked at, we wanted to get geographically similar, possibly similar populations. Idaho, generally, the facilities they have are smaller. These certified family homes, generally fewer than 4 residents. focusing on the elderly, but they also have mental illness, developmental disability, and physical disability in the same home. Acuity of residents in Idaho, as with some other states we'll mention, is addressed not at the licensing level, but at the level of individual residents. So at the time of admission, I think in this case it's the DHW in Idaho will be approving admittance of individuals to the facility. So they're going to be looking at the individual's own acuity and the match for the community they're going to be living in. So we don't have a lot of insight with the publicly available information as to how that discretion is exercised, but it could lead to more homogeneous adult family home type facilities than you'll find in Washington. And in Idaho, there's no professional liability requirement for those facilities. Then Oregon may be the closest match to Washington with their structure. We spoke with a research team at Portland State University about their experience and what they were seeing in that market. And I will say they were highly complimentary of Washington. They thought Washington's adult family home regulatory structure was a model. So that's a thumbs up from from someone who knows. So Oregon licenses adult foster homes, which are similar to a Washington AFH. Unlike Washington, they have specific license classes based on the level of care or the intensity of care required by residents. So they range from class 1, folks needing help with 4 or fewer ADLs, up to class 3, where you can have up to 1 bedridden resident. So being bedridden is a major deal in adult family homes, as many of you obviously know, due to fire risk and the like. In residential homes that are not built the same way a skilled nursing facility might be, the ability to evacuate, risk of bed sores, things like that are major, from an insurance company's perspective, very significant risk factors. So in some other jurisdictions, the individual licenses of the facilities kind of grade based on acuity. In Oregon, it was a little challenging to understand the entire scope of the regulatory requirements because not only does the state license, but individual counties can also license. So a not quite as uniform an approach as in Washington. And then Texas is the last state we looked at. Texas, and I'm sorry, I skipped over another state. Texas addresses the financial responsibility requirement at the bottom of the slide there, not through insurance, but through a mandate that each provider demonstrate financial stability before getting a license. So in Texas, and I believe Oregon may have been the other state, they actually take a look. They require looking at bank statements, your financial ability to operate this home, even without income from the residents. And so they don't have an insurance requirement. They do have that initial financial requirement. They also offer narrower licenses with the developmentally disabled, separate homes available for folks in that community. So our general impression, surveying other states, is that there's a very wide range of structures that states have used to encourage and regulate these types of entities. Notable differences between Washington and other states. Most other states have narrower licensing categories. So a Washington adult family homes license will allow a very broad range of residents in the same facility. Would not necessarily be the case in some other jurisdictions. And that may have insurance implications to the extent that insurance companies can't, just looking at the license, know the types of residents that are going to be in that home. And that can have impacts on the risk profile and therefore the pricing of the coverage. Also, not all states follow the Washington model of having liability insurance as a financial responsibility approach. Some states require assets in the entity and evidence of letters of credit or loans available to facilitate the operations and ensure stability. So we thought those results were very interesting, and there's a broader summary in the draft report.
Thank you, Stu. Yeah, and that's really, these slides will be publicly available, and then our final report, I think after it's submitted to the legislature, will be available with more detail. Okay, I'll try to slow myself down. I know I talk quickly,
I
but
took
so
too much
anyway,
time, Rebecca. My apologies.
no, it was me in the first place. Anyway, we have a lot of material to get through. So we need to talk about the liability insurance environment for Washington adult family homes. And I do not think Stu took too much time because I think a lot of his comments are very applicable to what we're going to talk about here. Okay, this first slide is really important, and it may be something that some people in the audience know off the top of their heads, and it may be not very familiar to other people in the audience. The insurance companies that provide general and professional liability insurance to Washington adult family homes currently either provide that insurance on an excess and surplus lines basis, or there is a big risk retention group that provides this insurance in Washington. So that kind of sounds like a foreign language. What are we talking about? So the important thing as it relates to this study is that the typical type of insurance that people think of in their everyday lives, like homeowners insurance, personal auto insurance, is all written on an admitted basis. That means that all the forms and rates for those lines of business or other lines of business that are admitted, all forms and rates must be filed with the Washington office of the insurance commissioner. Excess and surplus lines of business is typically written for specialty, unusual, or riskier business. And by law, the OIC does not, the Office of the Insurance Commissioner does not have the authority to regulate these rates and forms. They're not filed with the Office of the Insurance Commissioner. So that's important to know because we're very happy. It's terrific for the market that the ENS, and I'll explain in a second what an RRG is, that they have stepped into this role and said, yes, we will provide this insurance for the state of Washington, because the admitted carriers, the regular carriers that would have to file rates or forms, are not providing that insurance right now. So it's terrific that the ENS and RRG entities are providing that insurance. But when we talk about policy options, it's important to realize that these entities are not regulated in the same manner as like your personal auto or your homeowner's rates would be. And then the RRG, let me explain that. Risk retention groups are formed pursuant to the Federal Liability Risk Retention Act. They're exempt from most state regulation, and they're also not required to file forms or rates in the states in which they do business. So again, very grateful for their involvement, but none of these entities are regulated directly by the Office of the Insurance Commissioner. Okay, now as we start to head into the actuarial material, which I know you're all waiting for with bated breath, we need to talk about some general rating and underwriting observations. We learned this from talk with insurance professionals, and we also, this was substantiated by our data call. So first of all, adult family home policies are written by rated by licensed beds, not occupied beds. That's important because let's say somebody's starting off an adult family home and they're licensed for 6 beds and they only have 1 occupant to start off with, they're still going to be charged for 6 beds. That's because the review of the character traits of the characteristics of the facility, the characteristics of the residents, the inspection reports, the loss history only happens once a year. It only happens upon the initial issuance of the policy or a renewal of the policy. So and of course, if you're licensed for 6 beds, you're allowed to have up to 6 residents over the course of the year. So it's too hard for the insurance companies to monitor people coming in and out. For the most part, the premiums are not very high. So not very high, I mean, maybe a few $1,000s, but that cannot justify insurance companies always monitoring this. So people are rated by their licensed beds. Most of the insurance, or the vast majority of the insurance, is written on a claims made basis instead of an occurrence basis. Without getting into too many of the details, the claims made basis means when the claim was reported. The occurrence basis would be when the claim happened. So if something unfortunate happened in November of 2024 and it was reported in March of 2025, and your policy starts on January 1st, an occurrence policy would say that was a 2024 event because it happened in 2024. A claims made policy would say that was a 2025 event because it was reported in 2025. Claims made coverage is narrower, a little bit less expensive, which is actually good for our adult family homeowners for the most part. It can lead to certain coverage issues if people are not aware of them, which we discussed in our report, but we won't have time to discuss here. Okay, and just to give you a sense, insurance companies, each of the insurance companies that write this business have their own underwriting guidelines. I have a whole list of them. We have a whole list of them here. I don't want to go through each one because of time, but some only provide elder care. Some will provide insurance to AFHs that have residents of diversity of residents, maybe with mental health issues, but not if they have an elevated risk of violence or self-harm. Some will provide insurance to adult family homes with residents who need skilled nursing. Some will not provide. They might provide to the elderly, but they won't provide if the resident needs skilled nursing. Some won't provide insurance if you've had losses in the last 3 years. There's so many different, again, these slides will be publicly available, but actually when you think about it, those things might seem arbitrary, but they're actually not arbitrary. The insurance companies are trying to figure out who do we have the expertise to rate? What are the risks involved? The liability risks involved with a elderly patient who doesn't have skilled nursing needs are different than the liability risks for an elderly patient who does have skilled nursing needs. The liability risks for a situation where you might have a person who has had past episodes of self-harm, that has its own special type of liability risk. Even if the reality is that even if the caregiver did everything 100% and did everything perfectly, there's still the chance that the resident or the estate might say that there was some negligence on the adult family home operator's part. And so then they need to defend that claim. It costs money to defend that claim. So the insurance companies are each looking for their special niche where they feel like we know how to rate that, we know how to price for that, we can help the adult family homeowner mitigate risk, we know how to deal with that. But all of these different underwriting guidelines do present challenges to the adult family homeowner, right? And to the insurance company. So part of the issue, it's interesting, Stu mentioned that some of the other states we looked at had very narrow licensure requirements. In Washington, we have this really broad licensure requirement. Let's say an adult family home just opens and they've admitted one resident or 0 residents. And the insurance company says, okay, we'll take you on. The insurance company really doesn't know what type of residents they're going to admit during the coming year and whether those residents are going to fit the insurance company's underwriting guidelines. That can have a cost. Then for that same example, upon renewal, the adult family homeowners with ABC Insurance Company, it's time for the renewal. They submit the application. The insurance company says, oh no, we don't work with these risks, and the adult family homeowner and their broker have to go to a different insurance company to try to get insurance. Or here's another scenario, which I know will speak to everybody's heart who's familiar with adult family homes. Let's say you admitted an elderly resident, and when you admitted them, they didn't have dementia or had a very early stage of dementia. And then a year or 2 later, they're at late stage dementia. What if that doesn't fit the underwriting guidelines of that insurance company? Insurance companies have different protocols about residents who are already in place and whether what they'll consider at renewal. It differs from insurance company to insurance company, but you can see the tension that exists here between the understandable underwriting guidelines of the insurance company and the demands of adult family homes. And we have here at the bottom, RCW 70.129.110 even prohibits an adult family home from discharging or transferring a resident except in limited circumstances. So that really becomes a painful problem for everybody. If, let's say, a person's aging in place and their needs, all of a sudden they need a feeding tube, all of a sudden they need a ventilator, that becomes a problem. On the other hand, from a liability insurance standpoint, you know, as an actuary, like, yeah, if they have a ventilator, that's a different risk than somebody who doesn't. So it's really, really tricky. Okay, now we go. I know this is the part that everybody's going to really love. We talk about, so Rosemary and I are actuaries. We are the life of the party anywhere we go. Maybe Rosemary is. Nobody's ever accused me of that. But anyway, so we have our data call and actuarial analysis. Okay. So the OIC has been terrific, and we coordinated with them. And by the way, the OIC has been terrific, and all of our responding companies have been terrific. So, you know, basically as actuaries, our job is to try to put a number or several numbers around things. How much should it cost? Is it reasonable? So we worked with the OIC to develop a data call, which we had tremendous response to. It was amazing. And we wanted to get premium and loss data from 2019 to 2024. We usually like to have 5 years. The 2024 period was a little bit truncated. We truncated it at September so people could get their data in. So we had about 5 3/4 years. And we said this is always really important. Everybody who submitted data, the data is confidential. We'll talk about it in the aggregate here and in our report, but we're not going to use any identifying characteristics of any company. And we are grateful for the submissions. And so then we reviewed the data for reasonableness. If we had follow-up questions, we asked follow-up questions to the companies. And for the most recent years, 2021 to 2023, the beds in our data call represented over 80% of the DSHS licensed beds. That's a great result from a data call, especially honestly with insurance companies that are not, they're not admitted companies, and they're not always requested to do data calls. This was a tremendous response, and it felt very good for us when we were looking at the data. So we really looked at 2 different types of things. The first is we tried to look at premium per bed and premium per policy. We'll talk about that in a second. And the second is we tried to look at just the overall rate structure and reasonability of the rates. But we definitely wanted to look at premium per bed because really there was so much concern about the affordability of the insurance. So over 70% of our policies in the data call had 6 licensed beds. We asked for how many beds are on the policy. We asked for a whole lot of information. So every time, and so that kind of makes sense, right? Because adult family homes are usually licensed for 6 or 8 beds. Of course, it could be less licensed for a different number, but 6 was the most common number. So when we talk about like hypothetical premiums, we're going to talk about it as if it were a 6-bed policy. And again, that doesn't mean how many residents are living there. It means how many beds they're licensed for. Okay, so the 2023, again, 2024 was a truncated year. It was very valuable, but was truncated, so we wanted to look at 2023. That was the most recent full year of data. The 2023 average bed rate, that means how much money you paid for insurance per bed, was $480 from our data call. And that translates, if you had 6 licensed beds, that translates into $2,880. And then we had over 80% of the beds had an average rate of less than $550. So that's then less than $3,300 for a hypothetical 6 licensed bed policy. So we would say, you know, Rosemary and I would say that we do a lot of work with senior care, professional liability, and those appear reasonable. Even though it might be so painful to pay it, when you think about the amount of exposure the insurance companies had, maybe $500,000 per claim, $1 million per year, and in these circumstances, sometimes there are small dollar claims, but a lot of claims that come in are going to end up being very big claims. Even if the owner didn't do anything wrong, but if somebody claims they did something wrong, then you need to defend that. Just the defense costs alone can be very significant. So that appears reasonable to us, even if it might be really difficult for the adult family home owner to pay that amount. So over 80% would be like less than $3,300. Then okay, let's look at a bigger percentage. So then we said, okay, let's go out further. So over 94% of the beds had an average rate of less than $900, which would be $5,400 or less for an exemplar of 6 beds. That is more painful. That's more money than $3,300. It is more money. And we didn't have the information on a policy by policy basis to say like, oh, this is why that rate happened, or that's why that rate happened. But we do know that different adult family homes could have different dynamics. They could serve residents with greater acuity and greater liability risk. They could have facilities with different risk profiles. You could have a multi-story home where egress is a little bit more complicated in an emergency. You could have maybe some wanderer residents, which they have their own risk protocols if they might wander out into the street. There might be various levels of training or experience for the operators of the adult family home. All of these things go into the insurance company equations. So I'm not saying that that's easy to swallow, but it doesn't seem, on its face, it doesn't seem that surprising. There were 5.7% of the beds did have rates of $900 per bed or more. And some of them really, really were very, very high. So for instance, we had 10 policies with a per bed rate of $3,750 or higher. That's a lot. I mean, I'm not saying it's objectively a lot in terms of risk, but that's certainly a lot for an adult family home owner to pay. So we recognize that 8 of those 10 policies were written by companies which brokers had identified as companies that write riskier policies, that they're the companies that write the policies that other companies don't want to write. So of course, we can't talk about a case-by-case basis. And here's just a little graph, because actuaries love graphs. This kind of just shows you over here on the left-hand side, shows you the per bed rate. You know, if we stop at around 500 or 550, you can see that the vast majority of beds are here. The biggest slot of beds are at 250 to 299 per bed. And then you like smaller, and then 1,500 or more, you know, you have this uptick because it incorporates a wide range of possibilities. So I would just say in summary about that, I guess the important takeaway for me was, on average, and even for about 80% of the beds, we look at those premiums and we say that seems about right. For about 94% for the next 14% of beds, the premiums seem like, you know, ooh, that's a little higher, but it still could be right. And then there is that kind of tail outlier of like that 5% of beds, which truly the premiums are very high for the owner. We can't form an opinion as to whether that's reasonable or not. We can just say like, it's true. Some owners are experiencing high premiums, small amount, but some. The other thing we did in our actuarial analysis is that we performed an actuarial projection based on the premium and loss data provided to us. So we found a couple of things. We found that year to year, it's very bumpy. So some years, like, whoa, in the aggregate, insurance companies really lost money that year. Like the losses were much more than the money they got in, losses and expenses. In the aggregate, some years were great. Some years were like, oh, the losses and expenses really were less than the premium they got in. That's really to be expected in a situation like this, where a few claims, let's say you have a few $500,000 claims, or you could have 1 million claims if your limits are 1 million, 2 million. So a few claims can really, you know, think about if the average premium, let's say, what did I say, $3,300 or something like that? Or I said that's 80% of them are $3,300 or less. Think about how many of those premiums it takes to fill up a $500,000 claim or a $1 million claim. So some years are going to be harder and some years are going to be better from the insurance company perspective. And basically, when we looked at it in total, we said the insurance companies do look like they're operating profitably in the aggregate, but we did not find the rates to be unreasonable. Again, the admitted insurers don't want to be in this market. So the coverage is available because the E&S and the risk retention group market has stepped in. And E&S carriers, they're made for riskier business. So they're going to take some bad losses some years, and they're going to have some more profits some years. So as we'll talk about later, because of the nature of this market and because we don't find the rates to be unreasonable, our policy options are going to be more geared towards what can we do to make the market even better, make it even more appealing for insurers, increase the competition, those types of things. But it's really good that the ENS and RRG market are really actively involved in this coverage right now. Our projections, and I just want to caveat, actuaries love to caveat, but I need to here, the projections are uncertain because first of all, they project the future, right? Project future settlements and awards based on a limited history. And our history here in this data call, even though we got a great response, the history is limited due to the size of the market. And just for purposes of comparison, we had about 4,500 providers in 2024, according to DSHS. Think about, so let's say that's a maximum of 4,500 policies if everybody's buying their policy the way they should, right? And then think about when we talk about the private passenger auto market, we try to make projections on that. In Washington state, there's millions of policies in private passenger auto. So we're dealing with just a much smaller number of policies, trying to make projections on it. They're not going to be perfect, but what we found overall was that the rates looked reasonable and also are providing some profitability for the insurance companies. David, what do you think? I think we might have a few minutes for questions now, or should we just continue to policy options? What do you think?
I think it's a great time to pause to see if there's any questions before you go on to the policy. So if anybody has any questions or comments, please share. Okay, hearing none, let's go on.
Okay, that's great. But I was a teacher many years ago, and I hated when nobody responded. But this time it's okay because there's only so fast I can talk, and only so much people can listen to my crazy talking.
And I'm going to hold off on my questions. As you went through it, it's a lot of information to digest, and I had I did have questions, but I'm very interested in the policy options before we run out of time, so I'll wait.
Okay, sounds good. Thank you. All right, policy options. Okay, and I just said this, so I don't want to do overkill on this, but we didn't find that there was an availability problem. What we did find is for most people, for most adult family homeowners, is kind of within the cost that we outlined, and then there are some where they're really out in the tail. But for this reason, we don't want to suggest options which could disrupt the current market or cause companies to withdraw, insurance companies to withdraw. So our options are going to focus on creating a more flexible and responsive insurance market, education of adult family homeowners, adult family homeowner compensation, and factors external to the adult family homeowner which may impact their premiums. Okay, so policy option 1, because I can't make anything not complicated, there's actually a 1A and a 1B. But anyway, so policy option 1 in general deals with implementing licensing changes which may make the adult family home liability insurance market more appealing to new market participants and or may allow current market participants, by that meaning the insurance companies, to price policies with greater confidence. Okay, so 1A is, and every policy option, by the way, every policy option we're going to go through, some people are going to like it, some people are not going to like it. There's going to be advantages and disadvantages, and we're going to try to be as disclosure oriented as possible. These are for discussion, they're options. 1A is create narrower DSHS licensure definitions for AFHs. Okay, I'll read it slowly. The legislature may wish to consider creating more specific licensure categories for Washington AFHs, such that insurance companies have a clearer understanding of the types of residents that will reside at the adult family home. And in terms of the rationale for this, Stu did a great job of outlining how in a lot of our states in our survey, I would say that's a pretty common denominator we found in other states. Either their licensure is much more narrow, or they have a situation where they have to admit specific residents to specific homes to make sure that resident matches up with that home. We are concerned, and we actually heard this from some insurance professionals, that the broad Washington license may decrease the affordability for some adult family homes. We kind of talked about this already. When an adult family home is just starting up, the insurance company really has no guarantee who the residents are going to be. And we talked about this. There might be problems at renewal if, let's say, one insurance company typically writes the elderly, and all of a sudden at renewal, there's a developmentally disabled person, there's a person with maybe higher incidence of self-harm, different profile than they thought they were writing, might result in some dislocation. And also because the insurance companies are never really sure who's going to come in and out during the course of a year because of the broad licensure, they might have to charge a premium on that because of the uncertainty. So that's our thoughts for the rationale. The potential advantages of creating the narrower licensure is we hope there leads to better insurance affordability, and also the narrower licensure may, no promises, may lead to more insurance companies being willing to participate in this market. And generally speaking, the more entities you have competing over the same customer, the more they're going to want to make their prices more competitive. Also, it's possible that the AFH resident experience might be better. I mean, you can make arguments for that either way, but residents could be sure that the adult family home that they were selecting was really suited for their particular needs because of the type of licensure. And the owners themselves, some of the insurance companies or the RRG actually have risk mitigation efforts that are aimed towards certain types of adult family homes. If that license were narrower, the risk mitigation, the things that help the adult family homeowner could actually be more targeted. So those are some potential advantages. Some potential disadvantages is that, what do we do about right now? Right now, we have adult family homes, as we saw from the survey and as we just know from talking with all of you all. Right now, adult family homes are like, you could have in one adult family home with 6 residents, you could have 4 different profiles of people and within the 6 residents. So what would you do if all of a sudden your licensure were narrow? So perhaps if somebody wanted to implement this policy option, perhaps certain residents could be grandfathered in place, but then as new residents are admitted, it would be more consistent with the new licensure. No question that we still will have this aging in place is so important, and that would have to be considered, and there might be a certain tension there about what kind of, if somebody was just needed some help with activities of daily living, and then a few years later they need a feeding tube, does that mean they have to go somewhere else? In certain states they do. Washington tries hard to avoid that. And then we have to say that even if some adult family homes might get better premiums, more affordable premiums, because they're catering to the specific type of residents, they're licensed for those specific type of residents. Some adult family homes might get higher premiums because they're licensed for a different type of residents, and perhaps more funds would need to be allotted for those specifically licensed homes. And some residents might have reduced options because of the more narrow licensure, and maybe not as many adult family homes in that particular licensure category. So policy option 1A is creating the narrower licensure. We think it's very likely that this might help more insurance companies enter the market and price more effectively, but there's advantages and disadvantages. Policy option 1B also has to do with licensure, which is would there be an idea to enhance licensure requirements for new adult family homeowners? And just to summarize, perhaps the legislature might want to consider requiring prospective owners to gain 3 years of clinical experience or healthcare administration, perhaps as a residence manager for an existing adult family home, before becoming licensed themselves. And I just want to say about this, so some insurers, their underwriting guidelines require that you have 3 years of experience. So first of all, if you come in without those 3 years of experience, you're already kind of bumping yourself up to a higher premium model in many cases. And it may be that not having that experience actually might cause more liability, just you don't have the hands-on experience. We absolutely know that there are educational requirements before becoming licensed to be an adult family home operator. We know and we recognize that, but it may still not be the same as that 3 years of, it's not as much as the 3 years of experience that some of the insurance companies are looking for. And then an advantage, honestly, to adult family homeowner too would be, we have heard from a number of people that there's like these adult family homes that are opening up and then they can only get 1 or 2 residents. Or they try for a little while and then there's this change of ownership because they just can't make the business work. If you have that hands-on experience, maybe as a resident manager for 3 years, maybe you get more of a feeling of what it takes, even on the business side and the resident side, to make it work. Because it's for sure from an insurance perspective, and probably from other perspectives too. If you can only get, if you're only getting 1 or 2 residents in an adult family home, it might not work for you if you're licensed for 6. So getting that hands-on experience, even getting hands-on experience with, some people have said, a new adult family homeowner might not realize how important it is to be compliant with DSHS inspection guidelines. They just might not realize that it's really important. It's really important for safety, and it's really important for a lot of, just for reasons of not getting sued. It's so important. It's important for the care of the residents. So kind of living in that world for a little while might make you better equipped to present a really good experience for the residents from the get-go. Maybe be better at managing your business from the get-go, maybe, and get better insurance premiums and get a better first inspection report. A lot of insurance premiums go up because there's a poor DSHS report. Like, let's avoid that in the first place and get people who know how to get a good report in the first place. Potential disadvantages are slowdown of time to market. That could be an issue, right? We know how important adult family homes are. It might be something interesting for DSHS or another entity to study, and I don't know who would study this or how, but how many unoccupied beds exist in current AFHs? I'm not sure, but it is something we heard about a bit. So, but it might slow down more entrance into the market. And also this option may replace one barrier to entry, which is expensive insurance premium, with another, which is the other barrier to entry would be increased experience requirements. Okay, now I'm going to stop talking. Let Stu talk for a few minutes.
Additional option that particularly came out of our experience talking to folks in Oregon is education. And also talking with adult family home providers themselves and insurance professionals. People who get into operating adult family homes are primarily getting into it because they're experts at caregiving, not necessarily at administering a small business. We also understand there are folks who may have language barriers or the primary issue is these are healthcare professionals or people with sort of other kind of caring kind of focuses. Their understanding of, bookkeeping, the effort of trying to get budgets, it's not like there's standard accounting practices. So in discussing with folks, understanding about how insurance is rated, how the pricing based off licensed beds rather than occupied, that sort of stuff. The idea that additional and expanded training would be helpful. We understand there's a lot of training on compliance, caregiving, and the like, but on operating a business, developing a business plan, there might be an opportunity to do more to get people ready to succeed. And particularly with these very tight budgets, which we understand the gap between revenue and expense is not high for many of these folks. Having some training ahead of time and through the life course of their operations could be helpful. In Oregon, Portland State University offers webinars on a range of subjects. The Oregon government, their version of DSHS, has contracted with some academic institutions to make kind of continuing professional education available. And it's not just on caregiving, business operation, and the like. Other ideas that Oregon's not doing, but it might be helpful in Washington. Human resources, staffing one of these entities can be a real challenge. We understand turnover happens, and the other, Rebecca mentioned, turnover of ownership. Managing a work-life balance where your work is happening in your home can lead to burnout and difficulty keeping up that lifestyle that is also your business. So training on those and the aspects of operating a small business may help to keep those budgets in line and optimize the business side of these care facilities. So that was an option the legislature might want to consider, partnering with an educational institution to make that available.
Thanks, Stu. Okay, the next policy option is also dealing with kind of the very tight budgets that adult family homes experience and their push and pull with expense and revenue. We suggested that the legislature and/or DSHS may wish to consider providing more robust funding to adult family homes, especially to high acuity residents, to ensure the continued fiscal viability of adult family homes. And then, as kind of an aside, our understanding right now is that DSHS uses kind of a baseline operational expense and then adds on top of that, depending on the care assessment, there might actually be benefit from an operational expense component that recognized expenses that are not really acuity related, but are real. For instance, a non-ambulatory resident may have average care needs, but may trigger a very high insurance premium because of the risk of the risks related to egress in an emergency. The insurers are going to charge more for that because there's more risk there, even if they don't have a feeding tube, or they're pretty okay in many other ways. And so in this option, what I really wanted to emphasize is, and that slide way back where I said adult family homes are an affordable option, and their average bed rate is about half that of a nursing home rate and less than a quarter of a psychiatric hospital. So what we're wondering is there room to move that bed rate up somewhat so that the adult family homes can continue to be a viable option from a financial standpoint, but I think it would still be a great savings over the nursing homes. So that's the question. Is there a gap there that maybe that gap has to be a little bit narrower, but it allows a much better long-term viability for the adult family homes. And then policy option 4 also has a 4A and a 4B, some administrative items that are kind of just are part of this study. One is the DSHS, understandably during COVID, they're supposed to have these annual inspections, and of course they couldn't happen during COVID, and then there was a backlog, and we understand DSHS is working very diligently to get back on track and back to everybody getting the annual inspections they're supposed to get. And I think I think that backlog has really declined a lot, but I think we heard even from DSHS that sometimes there's trouble with staffing and getting everybody inspected every year. So just what happens is that because the insurance companies do rely on those DSHS inspection reports for information, if somebody had a few deficiencies one year and then there's a delay until they can get their next inspection report, they might have, even though everything might be amazing at this point, but if the DSHS inspection doesn't come out timely in the next year, then they're just going to end up paying those higher premiums until they can present that new report that demonstrates that they're fully compliant. And also prompt follow-up can demonstrate correction and incentivize improvement. Try to improve this because you need to do it for your residents, but also it might help your insurance premium, and we'll be able to come back timely and inspect that. And then the last thing is, it's just kind of an administrative item that we noted, but according to the WAC, the minimum policy limits are 500,000 per occurrence, 1 million annual aggregate, as we noted. Interestingly, the standard DSHS contract requires $1 million per occurrence, $2 million annual aggregate. And in talking with DSHS, I think in July 2026, if it's not, that's actually an exception. I guess the real standard is 2 million, 4 million, and they've made an exception for adult family homes for affordability, which I think will expire in July 2026. Then it will bump up, presumably, maybe to 2 million, 4 million. But even at the place where it is right now, 1 million, 2 million, that's in excess of the WAC requirements of 500,000, 1 million. And in our review, in our data call, about 66% of about 2/3 of the policies were at the 500,000, 1 million limits. About 1/3 were at the 1 million, 2 million limits. And requiring that higher limit is going to also impact the affordability of the policy. The insurance companies are going to charge more at the higher limit. So it would be good if those two items could get in sync. And then also just the standard DSHS contract language, which I'm sure is like extremely well intentioned to make sure the coverage is there. But it says, if you can see at the bottom of that slide, that it requires that the insurance company be an admitted insurer in the state, an admitted insurer in the state of Washington, et cetera. And, you know, as we talked about at the beginning, there are no admitted insurers currently providing this coverage. So the contract, people are pretty much automatically out of compliance with the contract. So maybe thinking about some of that language and thinking about the WAC and the market realities. And that, I am done talking. So any questions are welcome at this point.
Well, first, just thank you, Stu and Rebecca, for guiding us through that. Julie, go ahead.
I didn't want to go first because I know the gentleman from the DSHS had a
Yeah,
question,
okay.
so I'll go after him.
Okay, sounds good.
Julie, go ahead and ask your question, please, because I had a few comments on the recommendations and the way the data was collected. So
Okay.
go ahead, Julie.
Well, mine also might constitute comments, but I do appreciate all the work and can say also that we echo from our experience what Oregon said about Washington State and it being a model for this industry and a very positive model. So we appreciate all the work that has been done on this. The one thing I was looking at in terms of the policy considerations were some additional possible things to consider. So when you mentioned staffing, I don't know, because I know at the federal level at some point this was considered, but I don't know if there is any appetite for supplementing wages, that the state would provide some supplementation for the wage levels or tax credits, something that would increase the caregiver's wage level, because I think that would improve retention and things of that nature. So that was one thought. And then another, and it's complicated in the sense that I understand the unlimited nature of damages, but I used to be a plaintiff's attorney back in the day, and I do also understand when it's appropriate to have caps on damages and liability, and whether the legislature would consider that, because for liability insurers, that certainly does reduce the risk profile across the board for an industry. And so with obviously careful consideration, I think that they might be appropriate under these circumstances. So those were just a couple of policy consideration additions that I might suggest.
And some of the difficulty, Julie, that we have in Washington State is that I believe there's a Supreme Court ruling that damage caps are unconstitutional for the state of Washington. So, but thank you for your comments. Sir, go ahead.
All right, I'm Seth from Developmental Disabilities Administration, part of DSHS. And, first and foremost, I see, like in many of the residential programs we offer here, comparison with similar programs across the nation, it's always a challenge. But you guys did a very good job in capturing that. And the gentleman who was talking about the Boston, where the actually client moves into the person's provider's home, we have a similar model here. We call it the companion home model. So there is similarity there. The part I would caution is in the recommendation, there is some language about maybe adult family homes licensed to provide specialty population. Even though maybe from the insurance perspective, it might be attractive, but from the people we support, it's always a challenge. So we don't, where we do not want to create segregated settings. So we do not, people who access those services, they always want settings that are integrated. So it's not like, all people with developmental disabilities, they are housed or congregated in one home. 6 to 8 people is a fairly large congregate setting. The other challenge we see is if we don't do it by population, we do it by acuity. From the providers we hear is that they can support the variety of acuity. So you have some people with low acuity, some people with some behavior challenges. It helps run a cohesive home. If you have 6 people all with the high behavior acuity, it becomes impossible to manage the needs of all those individuals. So from the social services side, those are some of the pieces that came to my mind. The average, what I would say would be the facilities would be paying based on what was presented was about $45 per client per month. And that is still, for a small industry, that still takes away from the total revenues they receive. And it may seem reasonable, but from the provider's perspective, it does add up, and it gives them that much less revenue to apply towards other administrative costs. And I would like to maybe David from your office, from the insurance commissioner's office, I still like to understand because I don't have any insurance background, right? So how the agent, the presentation was talking about what are the insurance pieces that are monitored by your agency, and then they talked about the pieces that are not monitored out of your agency, and that's where our adult family home insurance sits.
Yeah,
And
that's right.
at some point, that would be helpful for us non-insurance people to understand.
Sure. And happy to meet with you folks to kind of go over all of the different layers of the insurance market, from the ones that are the most regulated to the ones that are the least regulated. There are layers of them. And by law, we regulate certain layers certain ways. So happy to schedule that with you at our convenience. Yeah.
Yeah, appreciate it. Thank you.
And with that, we are a little bit running out of time. We still have some time for some more questions, but I did want to mention that Rebecca's team is finalizing the draft right now. They will incorporate the comments that you've provided today. But if you have any additional comments, please, let me just send it. I've placed my email in chat. Please email them to me as soon as you can so I can get them to Rebecca and their team. We're going to have to finalize this next week and then get it to the legislature by the 30th. So happy to have any more questions.
I see Paula, it looks like she has a question in the chat. Is that okay if I address that one?
Sure.
So Paula wrote, thanks for the compliment. That's for me. The final report will be public, yeah, after it submits to the legislature, Julie.
Absolutely.
I hear from AFH owners that it's always more cost when they have a developmentally disabled client and if they drive a client to an appointment or outing. Right. So I can't say I'm an expert at that, but reviewing some insurance companies' underwriting guidelines, I would say that I don't know if they need to be dropped, although you're saying it does happen to them, but that is a risk. So what happens is, just from an insurance point of view, if you take, and I don't, I don't, let's just say the adult family homeowner has their car and their employees have a car, and the car is, it's used for just driving to and from work or whatever. But then all of a sudden, if they're using that car to transport developmentally disabled individuals, there's a whole different risk. It's a different risk than a regular personal auto liability risk. I have a child who goes to special school, and they're always driving them around in buses, and it's wonderful, but it does present a different risk. So that is a true thing, that if using the card, and now of course, like, you want to take your person to outings, right? And also, I think, like, that's going to be one of the underwriting questions, like, how do they get, let's say the developmentally disabled person has a job, at a supermarket or whatever they're working, how do they get to and from that job? And where does the adult family home's responsibility start and end? It is a real insurance challenge that you're bringing up. That wasn't the primary scope of review of our study, but it's a real challenge. And you want to be able to bring them out to outings for sure.
Yeah, and so my question would be, is it the same for folks that are the elderly clients that are not developmentally disabled? Or are the DD population being targeted as more risk? Because if that's the case, that's not, for me, that bothers me. I don't want our folks
Right.
to be targeted just because they have a developmental disability, because not all of them are none of them are the same, right? They all have different needs. So
Right.
are
Right.
they looked at differently than the elderly population? I guess is my question.
I did not see, I saw what I saw. And by the way, just to remind, excess and surplus lines companies and risk retention groups are not required to file their underwriting guidelines like admitted companies are. So whatever we kind of got out of the goodness of people's hearts and the promise of confidentiality, but for the underwriting guidelines that I reviewed, there was not that distinction there. It just was in general, like, we don't want people driving people around, which is kind of sad, but kind of makes sense. It's kind of the difference between having your own car and doing Lyft. It's not that extreme, but it kind of sets the stage for that. There wasn't a discriminatory thing about, who your resident is. But I could see, you want to give your resident the best possible life. I do wonder if developmental disabilities, if they're driving to and from work on a more regular basis, I wonder if that's a little different than, an older elderly person who goes out, once a month and an outing, just a frequency issue. But that's conjecture on my part. I did not see any evidence of distinction in that regard
What
from what I
about
saw.
in the AFH in general? We take out the driving piece. I understand the driving piece. What
Yeah.
about the AFH in general? Is it more costly for houses, AFHs, to have folks with a developmental disability than it is for the elderly?
So we asked for very detailed information, but we kind of said in our data request, we know you can get us this information. Please get us this information. If you can get us additional information, you can. But the way insurance companies keep their records, there's stuff we know they have, and then there's stuff they may not have to throw in a spreadsheet. So we couldn't get that level of granularity. I will say that some of the insurance professionals we spoke to, they actually thought that in some ways developmental disability was like less of a risk if it didn't come along with medical needs. In other words, an elderly person who has more skilled nursing or medical needs might actually be a higher liability risk than a developmentally disabled person who just needs a little assistance in activities of daily living. But that, again, is kind of hearsay. I can't say I saw that in the data.
Okay. Thank you.
Well, I want to say thank you, everybody, for the work over the year. Again, I put into chat the work group webpage that will host this recording, and also we'll have the final report posted on the 30th. Please hold on to my email address. I'm always happy to be helpful where I can in this line of work, and I hope everybody has a good rest of the day. Thanks for attending and listening. Take care.
Thank you.
Thank you
Bye-bye.
all. Bye-bye.
Bye.